Today, we're diving into the latest earnings report from Realty Income. This real estate investment trust is a household name for many income investors, known for its net lease properties and its history of decades of reliable monthly dividend payments. Let's unpack their Q1 results, discuss some key takeaways, and explore what this all means for investors considering Realty Income as part of their portfolio or the ones who already have it. First, revenue. Here, Realty Income came in strong, exceeding analyst expectations with a total of $1.26 billion. This is a significant jump, especially considering it's a 33.4% increase year over year. Now, a big chunk of this growth can be attributed to the recent acquisition of Spirit Realty Capital, which officially closed in January 2024. However, even if we take the Spirit acquisition out of the equation, there is still positive underlying growth happening organically within the core business. This is a very important sign for investors as it demonstrates the company's ability to generate revenue independent of major acquisitions, which are not gonna happen every year. How do we understand that? By looking at an important metric called same-store growth. This is a metric that shows organic growth, excluding the impact of acquisitions, or basically you can think of it as what are the assets of the company that are already purchased contributing to the business with. It essentially aims to show the core ongoing rental income performance, absent any major one-time events or recent acquisitions. This allows investors to track the health of the company's established portfolio and gauge its ability to generate consistent rental income over time. Here, the results were $843.5 million. This follows Q4, which saw same-store rental revenue of $714 million. The company is predicting around 1% same-store rent growth for the next year. Moving on, Q1 FFO per share was $1.05, beating the average analyst estimate by a penny and rose from $1 in the previous quarter and $1.04 in Q1 2023. Funds from operations is a key metric for REITs, which is used instead of earnings because otherwise the huge portfolio of buildings of these companies distorts the results due to paper depreciation. This basically means that on paper the company might even be losing money while it's actually printing profits because of the way accounting laws are set up. And so this is why we use FFO. The occupancy rate remained very strong at 98.6%. This is excellent news for maintaining consistent rental income as a high occupancy rate translates to less downtime and minimal vacancy losses. Despite the increased debt, Realty Income still boasts a healthy balance sheet with over $4 billion in liquidity, and what is the most important part for the high interest rate environment we are in, the company has minimal variable debt exposure. This means that even when interest rates rise, it doesn't immediately affect the majority of Realty's interest expense. Speaking of that, the company's interest expense coverage is 4 times, which means the profit, or FFO, they make covers their interest payments 4 times. This is not the best ratio in the REIT space, but it is pretty good. Overall, Realty Income's Q1 2024 results paint a positive picture, especially considering the recent acquisition of Spirit Realty and a less than ideal economic environment with rising interest rates. Now, let's do a breakdown of their key projections for the rest of the year. First, same-store rent growth. As I said, they are still expecting same-store rent growth of 1% with an occupancy rate exceeding 98%. This indicates confidence in their ability to maintain consistent rental income from their established portfolio, even amidst potential economic headwinds. Now, is 1% great? No, it isn't. But we have to remember that this is one of the largest REITs in the world with over 15,000 properties. We can't expect them to have double-digit growth when they are at this stage of their development. Also, bear in mind that their model is net lease, which means that they are not responsible for the property maintenance, insurance, or taxes, which of course lowers the rental increases they can ask from their customers, unlike, let's say, an apartment or self-storage facility. Second, capital investment. Capital investment is planned to be around $2 billion. This signifies their commitment to continued growth and expansion, suggesting they see attractive opportunities to acquire new properties and generate additional rental income. Third, AFFO guidance. AFFO guidance remains unchanged with a range of $4.13 to $4.21 per share for 2024. This indicates stability in their core cash flow generation capabilities. AFFO is adjusted funds from operations, which is basically a more clear version of FFO, showing more precisely the profit of the company. An interesting quality of Realty Income that not a lot of its competitors have is exposure to the international market. For example, on the earnings call, the CEO said that they are seeing better opportunities in Europe and also that 54% of the volume is in Europe. Also, because Realty Income has presence on both continents, they are able to arbitrage debt by taking lower interest rate debt present currently in Europe and then choosing to deploy it either in Europe or in the USA, which gives them significant advantage and flexibility compared to their American-only peers. So, to wrap it up, Realty Income's Q1 2024 results were solid. They exceeded expectations on revenue, maintained a strong occupancy rate, and reaffirmed their full-year guidance. The Spirit acquisition is integrating well, and the company has a healthy balance sheet with ample liquidity. While there are always external factors to consider, such as economic conditions and interest rates, Realty Income seems to be well positioned to navigate those challenges. Their focus on net lease properties, international expansion plans, and commitment to a growing dividend makes them a compelling option for investors seeking reliable income and potential for limited long-term growth. I personally treat Realty Income as a bond proxy, but unlike normal bond, one which both principal and coupon actually go up slowly over time. Don't expect this REIT to beat the Nasdaq 100 in terms of total returns or something like that, but I think it is one which investors can depend on for that famous monthly cash flow. Also, I think that the moment the Fed starts cutting rates, REITs like Realty will explode, which is one of the reasons I have one other REIT currently in my top 4 stocks and ETFs for the current environment we are in report, which you can check in the link in the description. The report will be sent for free directly to your email address. After you do that, make sure to continue with your investing education by checking out this video that should have appeared on your screen already.